Here with us. Karthik, talk to us about how your approach to the market been. What has worked for you and which areas did you miss? Because it has been a furious rally of over 40% from March lows. Let's take a stock of that from your perspective.
Hi Ajay, thank you for having me on this show. So we've always focused on companies with strong and sustainable earnings growth. We have an investment philosophy framework, which we call it as BMV, which is business management and valuations. The focus is on identifying companies which have, say, a strong growth and earnings outlook from a 5-year and 10-year perspective, and a lot more emphasis on cash flows. While we've been focusing on operating cash flows incrementally in the last 2-3 years, when overall growth itself has been coming down, the incremental focus is a lot more on free cash flow generation as well. As far as from this framework perspective, we have always been more positive on the domestic economy and the consumption theme, and within that B2C businesses, companies with high return ratios and good cash flows and good growth outlook. So what has clearly been our key positioning from last couple of years has been, say, overweight on private banks. The large banks have a strong balance sheet, a strong liability franchise, and good retail asset quality as well. And besides that, within financials, we've liked the insurance space as well. The protection penetration in the country has been quite low, and the growth opportunity from a next 10-15 years perspective is also quite attractive. So from that perspective, we've been positive on insurance as well. Of late, in the post-COVID world where there's been a lot of changes, we've increased our allocation to IT sector, because overall in the near term, the growth has come down significantly. We'll be looking at a degrowth this year globally as well as locally. And in that environment, IT sector may be less impacted, and also the currency depreciation helps them to a great extent. And these are companies with healthy cash flows, good managements, good track record, and valuations are still attractive on a relative basis.
Right. Karthik, that's good. Private banks and insurance clearly is something which has massively surprised everybody on the street. IT, surely getting in IT is also making sense now. I would like to get your view on another area which has got very good cash flow, barely any debt, and now the tailwind of COVID, and that's the pharma and chemical space. My colleague Utkarsh is here to talk about how government is actually taking steps to boost pharma manufacturing, especially API segment, and then I'll get your thoughts on that space. Utkarsh, fill us in.
So the government has gone ahead and notified 3 very important incentive schemes. Now the first one is for APIs and other drugs. Second one is for medical devices, and third is for medical parts and common infrastructure therein. I'll take you through all of them one by one. The first one is obviously on the incentive scheme when it comes to APIs and other important drugs. What they've done is they have chosen 41 products, which includes 53 APIs. The total financial outlay of the scheme is 6,940 crores, and the tenure of the scheme is from FY 2021 to 2029-30. But the scheme is only applicable for greenfield projects, and the whole idea behind is to make sure that we reduce our dependence when it comes to APIs. Almost 80% of APIs are imported. Now this is the same when it comes to medical devices as well. The government has gone ahead and approved the production-linked incentive schemes for manufacturing of medical devices.
Karthik, there's a lot of tailwind on pharma. Valuations have been low. People are talking positive about it, and API within that is an area which is of great interest for the market, and now government is also going ahead and taking measures. How do you analyze this space? Have you looked at it?
Yeah, so pharma, I would divide it into 2 parts. There is the part which focuses on the domestic market. A lot of MNCs are completely focused on domestic markets, and even some of our Indian companies have a significant contribution from the domestic market in the last few years. So this domestic market is largely chronic driven, and that is kind of a structural story with improving health facilities and people being more kind of starting to avail medical facilities. The domestic market is likely to grow both on the diagnostic side as well as on the pharma side. And that is something many of these companies generate very good cash flows, have a good growth outlook, and that's far more structural that we've always been positive on, and we've been overweight on that part. And even like I said, some of the Indian companies, the contribution of domestic businesses started to go up in the last few years because of the global businesses not firing as much. Now, coming to the generics business, India largely focuses on US and to some extent on the European markets. There, we've had issues in the last almost 5-10 years on pricing as well as regulatory issues. So to that extent, the growth and profitability has been taking a hit. But these are companies which have kind of scaled up significantly in the last 2 decades, generated very good cash flows, have reasonably strong balance sheet and very good track record. So as the outlook changes and even the government focus increases on more domestic production, even on the API side as well as the formulations, we should start to see that the growth momentum again picks up. What has happened is till March, I mean, last 4-5 years, we've been underweight on this part of the sector, and they had corrected significantly, and the valuations had become attractive. In the last 3-4 months, we've seen the valuations re-rating. Going forward, we have to see the number delivery. As the number delivery happens, there is scope for them to grow along with the earnings growth.
Right. Right. Karthik, right now in the country, the biggest spender is actually the government. They are spending on, infrastructure, on various schemes to boost demand as well. And of course, the capacity utilization of the private sector is very low. What are your thoughts on, this kind of a space which benefits from boost in capex? Large engineering EPC companies, construction infra companies, rates are coming down. Are they a beneficiary, or you think they are not a great area to look at right now? They are deep cyclicals, if you call them.
Right. Like you highlighted, they are cyclicals. And the private sector utilization was actually inching up till last year, and even before pre-COVID levels also, the utilization had come down significantly. And to that extent, don't think that the private sector's capex will come up in the next 1-2 years in a big way. The government side, this year again, because of the lockdown, the revenues are going to be impacted. So the headroom, both at the central and the state government level, to kind of spend aggressively on the infrastructure may not be very high. So we believe the investment cycle may be pushed out probably 1 or 2 years out. And like you said, the first it's the government which starts to spend, and as the economic activity picks up, the private sector also kind of chips in. But we believe that is still some time away. And cyclicals, you need to be able to catch them at the right point to kind of benefit out of the stock price movement in a short while. We've been far more focused on the structural stories, India's structural high growth and demographic led consumption story. So that's been the core of our portfolio.
Right. All right, Karthik, we'll let you go on that one. Thanks so much.